So, on paper, it looks like half of their wine business just spontaneously vaporized. But the reality is, they actually posted a monster quarter, mostly because America is apparently drinking an absolute ocean of imported Mexican beer.
Right, exactly. The wine drop is a complete illusion. It is just an accounting mirage.
Welcome to Earnings Unscripted. It is July 1st, 2026. We are looking at Constellation Brands, ticker STZ, and their fiscal Q1 2027 print. And yeah, the headline numbers here are super contradictory.
They really are because, look, they divested a huge chunk of their mainstream wine portfolio last year. So reported wine sales cratered 47%. But if you adjust for that, their organic wine sales were actually up 8%. But to your point, the real story here is the sheer velocity of the beer side. They generated $2.43 billion in total revenue. That is a 27% surge just from last quarter.
Which easily beat expectations. And the profit side was just as wild.
Yeah, absolutely. Diluted EPS came in at $3.79, which is just a massive quarter-over-quarter leap from the $1.16 they did in Q4. It is really strong baseline. But before I get entirely sidetracked by the cash flow math, just our quick standard disclaimer that everything we talk about today is purely our personal opinion, definitely not financial advice.
Yes, please do your own homework. But honestly, Miro, even with that massive earnings beat, the stock reaction felt like a complete fake out.
Yeah, the tape was pretty ugly. So immediately after the release in the extended hours, the stock surged. It broke past 144, touched exactly 145. It looked like a legitimate breakout, but then gravity just set in. By the regular open today, that momentum had completely evaporated. It was just a steep, continuous intraday sell-off, closing down 2.6%.
Wow.
Right. It basically just wiped out the entire earnings pop and locked the stock right back into that heavy downtrend we have been seeing since late May.
It is so strange to me because structurally, the core business is completely dominating. They were literally the number one dollar share gainer in the entire U.S. total beer category this quarter.
Well, they're tapping into something very specific culturally. The new CEO, Nick Fink, made a point on the call that I actually really agreed with.
Oh, the Knicks story. Yes, I loved that part. He was talking about how during the NBA playoffs in New York, young people were just flooding the streets, watching the games projected onto the sides of buildings. And he just specifically called those, quote, beer occasions. Like, he's laser focused on that communal, real world connection.
Right, because the stale out phase is basically over. Everybody knows Modelo. You can't really just put more boxes on store shelves. You have to create social gravity, right? You have to be relevant in the moment.
Exactly.
But look, here's the paradox. They shipped all this volume, and gross profit jumped 39% sequentially to $1.32 billion. But the operating margins took a really weird hit. They're carrying some major ghost costs on the books right now that are acting as an anchor.
Ghost costs from a factory that isn't even open yet. All right, let's get into the details.
Exactly. So what you have here is a weird... Actually, it is a timing mismatch. Management is aggressively staffing up the new Veracruz facility way before it produces a single drop of beer.
Oh, paying people to walk around an empty brewery.
Basically, the CFO, Garth Hankinson, spelled it out on the call. He said until Veracruz actually commissions, all those employees are going to sit in SG&A rather than in COGS.
Which explains the margin hit. I was wondering why operating margins felt slightly sluggish when gross profit just jumped 39%.
Right. It pulled down core beer operating margins by about 20 basis points this quarter, which sounds trivial, but on billions in revenue, 20 bips of ghost costs is a real tax on their own expansion.
Okay, but that feels solvable, right? Eventually the factory opens and that normalizes. To me, the much bigger red flag was the inventory math, the gap between shipments and depletions.
The gap between shipments from the company to distributors were up, roughly almost 2%, but actual retail depletions shrank. They dropped 0.3%.
So they are they are stuffing the channel ahead of summer.
Hankinson said that is typical. You always ship ahead of key selling seasons. But you do have to wonder if they are overestimating the consumer demand pull here, especially given the macro picture.
Right, which brings us to the gas pump. The CEO, Nick Fink, brought up this K-shaped consumer environment. They saw a massive spike in gasoline prices, and he was very direct that the consumer responded by slowing down.
Which is the real vulnerability for this portfolio. If you think about their core demographic, particularly the Hispanic buyer who over-indexes on labels like Modelo and Pacifico, if those buyers are suddenly paying $1.60 more per gallon in places like California, they probably trade down.
Or they just buy less beer entirely. Fink admitted they saw that slowdown in April and May. So now Constellation is sitting on all this product at the distributor level.
And that creates massive execution risk for the next 6 months. Because if retail movement does not accelerate fast enough to clear that backlog, you're staring down a painful destocking cycle in Q4.
So how do they clear it? Do they just pump money into ads?
They have to. They are basically spending their way out of the bottleneck. Hankinson guided that we are going to see a spike in marketing as a percent of net sales. He explicitly said it will be over 10% of sales in Q2 and Q3 to heavily support things like the NFL and World Cup campaigns.
Wow, so they are pouring fuel on the marketing fire to force that retail pull-through.
Pretty much. They do not really have a choice.
It's fascinating. They're pivoting from just getting boxes on a shelf to playing this massive lifestyle maintenance game. And speaking of playing new games, we have to mention the Corona non-elk numbers before we wrap this section.
The toe in the water comment. I noticed that too.
Yeah, he called it a toe in the water. But they're already number 4 in the non-alcoholic category. Think basically pointed out they have strong double-digit growth there, and they haven't even put a ton of weight behind it yet. It just flags this totally untapped white space.
Well, it requires a radically different playbook than traditional beer, but it is high margin. If they capture it, the pricing power in that alternative beverage alcohol space is fantastic.
But it all comes back to whether the consumer actually shows up to buy it this summer.
And whether they can afford the cover charge once they arrive.
Fair point. Okay, so stepping back, what does this heavy spending setup mean for their actual outlook the rest of the year? Because management sounded pretty cautious.
Incredibly cautious. The CFO, Garth Hankinson, basically said they refused to update the full-year outlook after just one solid quarter. The macro visibility is simply too cloudy right now, so they are leaving enterprise organic sales, keeping the core growth target parked right at a -1% to +1% range.
Which, honestly, that is definitely the smart play, because if you hike your guidance now and then the consumer totally taps out in August, you just set yourself up to look completely ridiculous.
Right, you get punished twice. They're playing it very safe. They've maintained that EPS target of $11.50 to $12.20, and they're keeping the free cash flow guide right around $1.6 billion.
Okay, so the true test really comes next quarter. We already know shipments ran hot in Q1 while real retail depletions fell behind. Plus, they are committing a fortune to this new saliency playbook, choosing to push lifestyle relevance because the distribution scale is largely maxed out.
Yeah, that is exactly the key metric to watch. We have to see if that massive ad spend in Q2 and Q3 actually forces those retail depletions into positive territory. Or, do they just cannibalize their own operating margins trying to force demand from a consumer that simply isn't there?
It's a great question. It makes you wonder, are they building a deeper moat, or are they just running incredibly fast on a very expensive treadmill?
I have definitely seen worse corporate treadmills. But yeah, spending north of 10% of net sales just to remind people to buy your beer is a tough defensive posture to maintain long term. We'll see if it pays off.
Let's just hope the consumer actually shows up to the party. All right, I think that is a wrap for our breakdown today.
See you after the next print.
If you want these earnings breakdowns to just easily show up in your feed, go ahead and follow the show. As a quick reminder, this podcast is an AI-assisted project. meaning we use AI to help process all those massive financial filings into actual human conversation. We'd love your feedback or any ticker requests you might have. So feel free to email us at earningsunscripted@datamadness.ca or grab the X link down in the show notes. Thanks for listening.
Take care, everyone.